Screen share here. Let's get this meeting started. July 3, day before July 4th. It's also my wife's birthday, by the way. So we had some partying this weekend. Okay. Share my. All right. What an amazing set of speakers here we have today. This meeting is not legal or financial advice. It's simply professionals sharing what we do. And today, in just a moment, I'll be introducing our most amazing guest speakers, Amanda Cox and Katie Neuman.
Thank you, sir.
And our speaker for next week is Sean Ricehouse. Monday evening at 6:30, same time, same location, same Zoom link. And a little bit about us here at Eagle City Multifamily. We're operate here in the DFW area, and we raise capital to purchase apartments. Produce above average returns for investors is the goal. So I have a couple partners here, Nikki Ma and Dr. Sanjeev, along with Asif Kumar. We're all based here in the Dallas area. And now to our most amazing guest speakers. Amanda Cox serves as the Chief Operating Officer of Bel Air Services Corporation and Bel Air Multifamily Management. She spent 15 years in multifamily property management, and before joining Bel Air Service Corporation, she was overseeing 11,000 units amongst 8 markets across Texas, Oklahoma, Arkansas, and regional vice president of operations with one of the largest Texas-based property management firms. She is a member of the Institute of Real Estate Management, of which she served as president of the Austin chapter in 2020 and holds a seat in the International Governing Council for the organization. And Katie Neuman. Katie began her multifamily career as a leasing professional in 2006 and has held every position from leasing professional to director of operations. Her expertise is in developing budgets, generating comprehensive reports, overseeing successful property integrations, executing strategies to improve the NOI, net operating income. That's what we're all looking for. All right, go ahead and introduce yourselves, Katie and Amanda, and I'll stop screen sharing. That way you can share.
Awesome. Thank you so much. So let me get my presentation up as we are going for this. Can you see my screen?
Yes, loud and clear.
So I am joined here today, not only by myself, but Amanda Cox, our COO of Bel Air Multifamily Management, and also our Director of Acquisitions, Tyler Williams. So we actually have 2 different companies, as mentioned in Amanda's bio. We have Bel Air Services and Bel Air Multifamily Management. So we'll touch base a little bit on both of those. But thank you for having us. We are very excited to be here tonight and show you a little bit about what we do. So Miss Amanda, I'm going to kick it over to you. Why don't you tell us a little bit more about Bel Air Multifamily?
Absolutely. Thank you, Katie. I just hope I can follow after you. Okay, so Bel Air Multifamily, we are a management company, full service, servicing third parties specifically in the BC asset class. We love a good value add. So we're only focused in the markets currently that we have leadership with at least 10 plus years experience in that specific submarket. So that includes the full 35 corridor from DFW, Austin down to San Antonio. And we find that this is really valuable because we want to keep our company intimate. We are a small company that is by design because we want you to have that experience with the the leadership that is leading the company and leading the day-to-day within each of our teams. So we know the vendors, we have the employee bench, we understand what's going on in these submarkets, and have seen through the trends of at least the last decade together. So currently our property management team is about 1,200 units throughout these 3 different regions, as mentioned. And we're just here to be a resource to our clients. We've all come from institutional experience, and really we're passionate about bringing that to the syndication space. So we can assist with underwriting, we can help with the creation of a business plan, not just taking the autopilot, we'll be your management company. We really want to be here to partner with our clients and assist with this full suite of services that our company offers.
Thank you, Amanda.
Absolutely.
Okay, so today we wanted to talk a little bit about the market conditions, what we're seeing. And in particular, we chose to focus on the DFW market. And as you know, the Metroplex is huge. So there's a multitude of submarkets where some of this data will vary, but overall in DFW, we're starting to see the market soften. I think this is a really important trend to pay attention to. As you can see here on our slide, over the last 12 months, about 29,000 units have delivered in the DFW submarket. Now, if you pay attention to that next KPI, only 7,700 have been absorbed. So we're starting to see that absorption rate really slow, which will then trickle down into a higher vacancy, maybe softer rent growth. And so that's what we're going to dig into today, along with some financing info and maybe some tips and hints on how to avoid a pitfall should you get into your next acquisition and what you should be looking at. So here, I also want to highlight, and I'll kind of circle it here, is we are utilizing CoStar market data. So the way CoStar talks about certain products, they rate it on a star level. So 1 to 5 stars. So that 5-star being your A++, your A, maybe your A-, your 4-star, you're going to see that A-, B+B, and then 3 and below, you're going to start to see that in your B- space, and your C product and anything below that. So as we talk through this, I think it's important to kind of be cognizant, because not only do these trends depend on what submarket you're in, maybe it's the HEB market, maybe it's Collin County, Plano, Frisco, but also your asset class, because every single asset class is going to be impacted differently during this kind of turbulent time that we're seeing, or uncertain time that's coming up. So jumping into rent growth, this is really important. We're starting to see this soften. So overall, on average, we have seen a negative 0.4% reduction in rent growth. Now, keep in mind, the hardest hit markets are going to be that 4 and 5-star market. So your A++, your B+. Now, you start to see that kind of show a negative rent growth of 1.7%. So that's a pretty big decline over what we're used to over the last few years. Now, your value add deals, so your C and B product, they're a little bit more resilient, and they're actually seeing a slight growth, not a decline, and they're seeing a slight growth of 0.7%. So what I want you to take away from this is it's very important to make sure when you're analyzing a deal or projecting your next year's budget or completing an underwriting, to make sure you're aligning your business plan with what the market goals are, or what the market's dictating, really. Now, if you get into vacancy loss, we're also seeing that tick up. So notoriously, we've run, around a 5% or so vacancy here in DFW. We're now averaging 8.8%. So that's an important metric to pay attention to. And that's 2.3% higher year over year. So this is one of those things where you're going to see that backdoor be more important. Your residents are going to want to stay in place due to all of the economic uncertainty, the inflation, things are costing more, moving around and getting a new place may not be their priority. So we really want to focus our plan, and for our management side, on closing that back door, building our resident retention, making sure we're providing a place that our residents want to stay at so we can continue to push that lease trade out and that rent growth on renewals. But it also means it's going to be harder to fill it up should you not close that back door. So we're starting to see, again, that absorption rate. It's harder to get new people in the door. So these are all things to really pay attention to. Now, everything that we've been seeing and the market data we've been reviewing is really showing, in particular here in DFW, that mid cities and older Dallas suburbs are going to be the areas where rent growth is most consistent. So this is your Arlington, your North Richland Hills, Haltom City, HEB, Hearst, Euless, Bedford. That's where we're operating right now. They've seen rent growth above the metro average for the last few years. So it's very important as you're analyzing deals, location, location, location. Now, right behind that mid-city market, another market we're really keeping our eye on is that Mesquite and Garland. And that's really just because we operate in that BC space. That is where our demographic lives. And that is where this affordable housing option comes into play for them as well. Amanda, any other color you wanted to provide on the market here in DFW?
Sure. Yeah. Thanks, Katie. That was so much really great information for you to be sharing from CoStar. I'll just give a perspective from our company specifically. We're seeing this softness in CoStar. We're not experiencing it at our properties, though, at this point. Being that we do look at the forced appreciation, we have pulled back a little bit on some of our scope. For instance, we had a property we underwrote a year ago and said, we're going to put in new cabinet fronts. We're going to put in hard surfaces. That looked about at $8,000 to $10,000 a door renovation. What we found is that there's still so much demand that we can get our pro forma rents at a $6,000 a door renovation. So we've really honed in on that scope to understand with these times ahead, we think the waters are going to be rocky, but are we over appreciating, or are we really keeping to account what our scope should be and saving some of those dollars for contingency for a later time? The market improves, we might see that additional rent bump, but we are being really cautious about that and not overspending on the assets currently. Outside of that, we've had great rent growth, in the HEB area specifically that Katie mentioned. Our trade outs have been averaging about $100 on renewals, so still very strong. But I will say, as we're going into the third quarter, those renewal offers are going out at this point, and we're looking at $25 to $50 increases because we'd rather keep someone than have to replace that lease. Not only is it the turn cost, but the vacancy, the concessions that are coming into the pipeline. A $25 rent increase, or let's say $300 over a 12-month lease, you can't turn a unit for $300. So we're really just trying to make sure we're keeping our finger on the pulse. We're adjusting as needed, and we're advising our clients of such as we continue forward and, continue to watch these market trends. I'll turn it back to you, Katie.
Thank you, Amanda. So now we're going to move into a little bit more on the financing side. What are we seeing? What have we seen in the market? And for this, we're going to turn it over to Tyler Williams, our Director of Acquisitions.
Well, thank you, Katie, and hello, everybody. It's nice to be speaking with you all this evening. Yeah, well, what a ride it's been. It's hard to think back to pre-COVID life. And the rush and the growth that we experienced kind of in the decade leading up, probably one of the most prominent real estate in quite some time. But we saw things mid last year, going into the winter and into the fall, really flip on a dime with interest rates going up, the Fed taking action against inflation. We've seen, sales looking back at Q1, dropping over 60% and loan originations kind of following in tandem. The cheap debt that we were all getting used to getting our hands on in 2020 and 2021, and even some in 2022 really has evaporated. The bridge loan environment, or floating rate, or variable rate loans, that were that were out there for us are no longer viable options because of the uptick in interest rates. And most of us looking in the acquisition space right now are leaning back on agency financing with Fannie and Freddie Mac. And obviously the Fed's come out and has spoke to a couple more interest rate hikes this year. We certainly won't get back to 0% interest rates, probably until the next big event, whenever that is. It's back to really looking at the fundamentals of deals. Looking at sizing on actual financial results, as opposed to some of the business plans that we were able to pro forma, just a short time ago. Katie, if you want to hit the next slide, we'll just keep talking. So, just kind of along the same vein, of all that bridge loan activity, and really just in the commercial real estate, market as a whole. There's about $1.5 trillion across all asset classes, with debt that's coming due between now and 2025. Some of those by design fall off. Some of those not by design. We look at the multifamily space in particular, and again, we look at kind of our transaction landscape, where most of our originations were coming from, or at least you could probably say so in some of the Sun Belt markets. We're done with short term, three-year term debt with very aggressive business plans, and a lot of those business plans, while they may be coming to fruition, cannot keep up with the rise in interest rates. So it's going to be really difficult for borrowers to be able to refinance, if they've got a maturity in that time. So we're taking a hard look around the DFW Metroplex and around some of our other key markets at some of these opportunities. And of course, like we've mentioned before, through CoStar is one avenue we do that. We also have several key broker relationships, as well as several relationships in the capital markets and the debt side of things. And those are very key. And working with those folks, not just being there when the times are good, because the transaction space, it affects everybody. It affects people at the property level. It affects folks like us, and then it also affects the sales brokers, the debt brokers, and so on and so forth. So it certainly has had chain reaction, like effect, and it's is certainly going to continue. And we've already seen very small cracks on the surface with some groups in the Texas markets going belly up. Certainly don't think that is going to be the norm, but they are going to be out there. Multifamily is so often referred to as being more resilient than most asset classes, and that will remain true. But we will see some distress because of those interest rates. And the other thing I want to touch on with interest rates rising. So again, anybody that has a floating rate deal, and I know we have one. I've experienced and been a part of many in the past. As interest rates, as federal rates go up, interest rates go up, and then our cost to borrow goes up. So monthly debt service can rise. And again, back to some of these business plans. Sometimes these business plans aren't meant to keep up with interest rates going from 0 to 5% in the fastest time, and I think in the history that it's been tracked. So there's just not enough time to play catch up. And so what we see is we will see some properties that may have cash shortfalls on a monthly basis as they can't service their debt. So ultimately, what does this mean as an LP or as a GP? Well, they've got to find a way to put a cork in that stop loss, by continuing on their business plan, continuing to increase income, finding ways to get creative on expenses. But that, it will only go so far in this environment. There's going to need to be other avenues. One avenue can be through refinance. But again, in this environment, values have also dramatically gone down. So the ability to refinance may not come easy. It may require more capital, sometimes in the form of rescue capital. And some key things to look for if you're an LP in a deal, and you're unsure of where you stand. It's certainly good to get involved with your sponsors. Ask them what type of loan product your property is operating under. if they're operating under a bridge loan or a variable rate loan, or floating rate, however they want to word it, be sure to get a hold of those financials. And I know Katie's going to touch on that in a little bit and get ahead of myself, but get a hold of those financials. Understand, you want to understand what coverages are on the table in terms of your loan agreement that you're involved with. You want to know what's on the horizon if the loan does run into trouble. And we're going to touch on debt service calculation here in just a second. But just be involved, ask questions. The more ambiguity, the more nervous you should be. But take the time to understand. Certainly, as you look to invest here in the near term, there will certainly be tons of fixed rate opportunities that come, as those will be kind of the only channels that we go through. So, really challenging times as we look to source deals. I will tell you, I remember some conversations back in December with some folks that I've worked with for a long time, and the conversations had never been so bleak. But as we kind of crept out of the cold a little bit, and we all shuck the cobwebs off. The market has certainly continued to move, but that bid-ask spread between what sellers are looking to part ways for and what buyers can accept is starting to shrink. Deals are starting to come back into the picture, and avenues are opening up. And we're also, as the summer goes, we certainly see deal flow pick up, and that's been the case. And we certainly think that's gonna continue. So in the long term, real estate is resilient, and it will continue to be. And especially in the DFW market, we think there's tremendous opportunity, and we're very eager for these next few years. I don't know where we're going after this,
Tyler.
Yeah, no problem.
So that being said, we wanted to talk a little bit about what does this mean? I mean, everybody's seen on the news some failing properties. How do you navigate out of this? What should you be looking for? And what should you do on acquisition to avoid some of these pitfalls? So for that, I'm going to turn it over to Amanda, where she's going to talk about DSCR in particular. Why is this so important? And what are some of the other key factors that we should be looking at to make sure we're properly vetting a deal?
Perfect. Thank you, Katie. Yeah, so we really found that this section of our presentation is such a value driver. We've all personally invested as LPs in multifamily. I will be the first to tell you I had no idea what debt coverage meant. I was just encouraged in the industry, like, you should go out, make investments. Some of them are going to be better returns than others, but the best day to start investing is now. And I wish I could tell you that I knew this back then, and I didn't. So we really thought that this would be valuable to go over today. So we're talking about the debt service coverage ratio here, and you can see some of these bullet points on the slide, a few things that we want you to be considerate of. So essentially what we're doing within our company, and we're encouraging you to do as well, is to be looking at your NOI and looking at your debt service on a monthly basis, and then creating your DSCR at least on a T1, T3. We're also doing a T6 and a T12, because we want to see every month when we're closing our financials, have we made that upward mobility? Most loans are typically a DSCR of 1.25 minimum. And this is really the gauge of your financial metrics of how comfortable your lender will be to give you the best terms when you're looking to go through a refinance for your property. So it's not abnormal to find those deals that have lower DSCRs. Those are opportunities for you, especially if you're forcing appreciation, but you have to be mindful of how long is your term of your loan and what are those covenants, and are you going to be able to meet at least your minimum coverage, and also gauge, what other opportunities you'll have, in the refinance or the disposition of your property. So typically, just, generally speaking, I'll keep it high level with DSCR. The higher that it is, the greater margin of safety. So you want to see well above 1.25, because your property can withstand unexpected expenses or fluctuations in rental income. A lower DSCR is going to be indicative of a property that's not able to handle market downturns or raising expenses in the short term, or especially in the long term. So there are times when we're looking at our debt coverage and we decide to shift in business plan. Sometimes that is necessary. You might have to add in a value add strategy or look at reducing expenses. You know, good management companies are always shopping vendors, always looking to change and save you money on your landscaping, your trash, and your pest control, like any of those types of services. But as Tyler mentioned earlier in the presentation, that's not what's going to get you there. You're going to have to look at areas of opportunity to improve your product, to bring in maybe some outside services. Like all of our residents are paying for internet. Maybe not as much cable now, but let's be confident in the internet side. What if you're able to get an upfront door fee through a company like Spectrum and you pass through a similar type of service to your residents? That's another opportunity for ancillary income. It's driving the value of your property, and you know that your residents are going to be paying for a service like that anyway. We've looked at several different options across our portfolio, and are hyper focused at this time, not only on closing that back door, seeing what our forced appreciation can do on the value add component, but really hunkering down on, you know, any expenses that we can control at this point, and just ensuring that we're gauging our stability across the portfolio. And so to be able to attract your best financing terms, you're going to want to really focus on that DSCR. And so ultimately, the goal is that you have lower interest rates, you have longer repayment periods, and ultimately longer or higher value amounts as well. All right, so let's get into rescue capital. So I know we've mentioned this a little bit leading into this point in the presentation, but this is something that we see we're starting to be approached with these opportunities now, and we think that this is really the cracks starting to surface, and that there will be additional opportunities specifically in the rescue capital space. And what we mean by this is the ability to infuse funds into a deal that's distressed. It could have poor occupancy, deferred maintenance as it's been undercapitalized in the underwriting process, generally underperforming, and could be headed towards foreclosure. And the primary objective of bringing in rescue capital is to improve the property's operations, save the deal from going back to the bank, and addressing any underlying issues to position it for a more long-term successful position. So a few things that we are focused on at Bel Air Multifamily is, you know, properly reviewing the renovations, looking for opportunities on the improvement side, enhancing the property management. It's probably a common sense, but not common practice at all properties that we go secret shop, that your office has got to be open. You've got to answer the phone. You have to support your residents and let them, you know, be there to support them and accept their rents, to handle their challenges. And a lot of the properties that we have been shopping have really missed the mark on the management side. And if you don't have a team that's on site and passionate about what they're doing and supporting their residents, you can't expect to meet the metrics that are so important, especially going into the turbulent times that we see ahead. We're also helping with market repositioning, as well as structural refinancing. There's a couple bullet points also on the slide here about the benefits of bringing in rescue capital from a LP side and a GP side as well. You know, the goal is to preserve your investment. If you're able to get out with less returns than what were anticipated, but not lose your investment, that is an ideal situation. We're seeing GPs go after rescue capital, diminishing some of their returns to be able to save the returns of their LPs. And I think that as we're seeing these opportunities, you know, we're noticing that there is some distress, but also I personally give kudos to those teams, you know, those GPs that are out there looking for this money now and not putting their head in the sand and wondering like, oh, my property operations are just going to get me there, because that is not a sponsor that is probably communicating. They're not ones that are really thinking about the long term. And so I actually really commend the sponsors that have been reaching out to us about those opportunities. Ultimately, you can make an impact on your property by properly positioning it, bringing in the right capital stack if necessary. And this is, an additional opportunity for investors that could get into deals that might not have, on the first go around, and at times at a better return hurdle because the position of the property.
Yeah, and I think just to add some more notes, why now and why so fast? You may have, as an LP, you may have seen this, already happening on a deal maybe you bought just last year. It's important to know, kind of like we said earlier, just wanted to go back and circle back. With the rise in interest rates, let's say your GP closed on a deal and the interest payment was $50,000, and they had a floating rate, variable rate loan, back in March of 2022. Well, that same loan today that was, it cost $50,000 a month in interest is now, probably well over $100,000, $110,000, $120,000 and still climbing as interest rates continues to go up on a daily basis. There are interest rate caps that can be put into play, but that's a topic for another discussion. But at any rate, those funds are and those expenses are still real and still have to leave the property first. That's one thing. The other thing is valuation too. As interest rates go down, like we saw in 2017, 2018, 2019, and then ultimately getting to zero. For those of you who follow the U.S. Treasury, with the U.S. Treasury falling below 1%, as those rates fall down, access to capital gets much greater. And so with the ease of capital, like we saw cap rates also go down. We saw values go way up. So the real thing that a lot of people didn't take the time, and lenders, bridge lenders specifically, didn't take the time to consider, didn't have to consider because of their access to capital, was the cap rate spread between asset classes. So a lot of my personal underwriting, from call it late, mid to late 2021 through most of last year, well, really till the spring of last year, we were underwriting deals. We were underwriting C-class deals to the same cap rate as an A-class deal, which doesn't, okay, well, I could, you could probably make sense of that with rent growth and this and that, but one of the things that you really don't account on the back end necessarily, if you're not careful, is when interest rates move out, and what are the first things to drop in value? It's going to be your lower tier or your lower class properties are going to see value escape much quicker than a building that was built in 2020 versus a building that came online in 1968 and has clay pipes and massive roofs. So that cap rate spread got really tight, and so there was a lot of folks that that were potentially new to the space. And there's a lot of folks that weren't. There was really seasoned, institutional groups buying C-class deals really at the same valuation as A-class deals. And as interest rates started to move, so did cap rates. Cap rates do lag interest rates, but nevertheless, they still began to expand. And when that happens, and we kind of circle all back, the business plan can only take you so far. Obviously, we had, I don't know what the statistics are for DFW, but double-digit rent growth for however long, that only runs so far. And now we're seeing all that reverse, just as Katie showed. And a lot of those business plans for a C-class asset just won't make it. And that's kind of also where you're seeing these huge disparities. Just wanted to touch on that. I think we all muted. Sorry, Katie.
Sorry, I was trying to get my unmute button here. Thank you, Tyler.
Thanks,
So
Tyler.
that kind of brings us to the end here. What do we need to be paying attention to at acquisition to avoid some of these pitfalls? Here's the top 5 areas that I would recommend that we pay attention to in underwriting a deal. And that is completing your comprehensive financial analysis. Scrutinize those income and expenses, verify them, dig in, find out how the property is really performing, and also make sure your underwriting accounts for anything that you want to do to the asset. If who you're buying it from is running it with a ton of deferred maintenance, they're not fixing things, you're not going to want to base your expenses on theirs, especially if you want to be able to push rents. You need to preserve your assets value. Second, be in compliance with all applicable laws and regulations. It's critical to mitigate any risk. You don't want a surprise like that on the back end. Understand your market. As I said, there's pockets that do extraordinarily well. One example that we recently came across, and I find this interesting, is we're glancing through a business plan. They said area median income within 1 mile is 70-something% or $70-something thousand. That sounds really great for a target demographic on a C-class asset. The very next line in this business plan is there's no competing properties within a 2-mile radius. So be able to distinguish, there is an issue there. There is no competition for that particular market. It's all going to be homeowners. So make sure you're really digging into the demographics of that market and your target demographic for your property. You really need to understand where that ebbs and flows, where to adjust for a downturn. The days of us seeing 10 to 20% rent growth on a new acquisition are probably gone for a while. So you want to underwrite a little more conservatively depending on market conditions in whatever submarket you're looking at. Evaluating your property management company. Amanda touched on this. This is wildly important. We show up, we secret shop assets. We're there to take a look around. There's some buildings we can't even get into, and they might only be 80% occupied. There's a problem there. You want to dig in. Your property management company is your partner in your property's performance, and they're the ones to execute your business plan. So this is wildly important to make sure you have the right partner that understands your business plan, where you want to go, and have them there to help you. Have them there to help you build up your ancillary income. Get creative in ways to bring in that income like Amanda talked about. And then lastly, assess the physical condition. This is huge. There's so many times we walk into an asset and we're taking a look and it's not capitalized correctly. You cannot achieve large rent increases and close your back door if your property is falling apart. And it also doesn't preserve your assets value. There's several assets we look at on an underwriting basis where the deferred maintenance is too great, and therefore the deal no longer makes sense. Don't ignore those small things. You start ignoring the small things, they build up into bigger things. So make sure you're looking at the deals correctly. Make sure you have a proper capital plan and allow for contingencies as well. Amanda, do you have anything else to add on that?
No, I think you did great, Katie.
Okay, perfect. Well, now we want to open it up for some Q&A. Does anybody online have any questions, comments, concerns that we can dig into and answer for you today?
Katie, I have a few comments. I really enjoyed your presentation, Katie and Amanda and Tyler. That some very great information there. And I believe as well that it's we're coming into probably some of the best deals, in our, the past few years, right? It could be the best time to invest in the next couple years, right? And a couple things that stood out to me. You said the A+ and the B+ were hit the hardest on one of your slides there. That stood out to me. And another thing, Amanda, you mentioned you're at an apartment, and I think that's great that you're actually at one of your apartments for a community event. I'm curious, is that one of yours, or is it like one you third-party manage?
It is a property that we third-party manage in Austin, and we just took over this property at the beginning of June. So we're coming up on our 1 month here, and the residents just needed some love. So we had our team come out, our maintenance guys grilling hot dogs and burgers. He is so excited to be a part of this community, and so are the residents. So, it doesn't have to be big, extravagant events. It can be 50 people at the pool. Well, I think we only expected like 20, but it's pretty popping out there. But it's such a great way to build that community, because if your residents are friends with each other and they're creating their own community, it's highly unlikely they're going to leave their friends, right? They're going to just keep renewing and staying at our property. So trying to put our best foot forward here today.
I love it. I love it. We have great property managers, but I'm really interested in that. Sounds like you would be a great partner as well. As
We know how to pool party, I'll tell you that.
Yeah. Yeah, any questions from anyone online?
Can I ask what cities you actually operate in right now? I
Yes,
get that it was all
absolutely,
Texas.
Charles.
Thank you.
Yeah, so currently we're operating in DFW, Austin, and San Antonio. Again, we kind of run that 35 corridor here in Texas.
All right. The way you were pushing HEB, and I don't know if you're allowed to say names, what do you got in Bedford, or what can you say about a Bedford property or something like that? Just because I live here, I'm curious.
Yeah, so currently, Charles, our assets here in DFW are all actually located in Hearst, which is
Okay.
Bedford adjacent, as you
Next
know.
door? Yeah.
So
Okay.
with the Hearst submarket, we're seeing still, like Amanda said, amazing rent growth. We're
Mhm.
hanging on here. We're riding this wave until we can't anymore. We're seeing huge lease trade outs. We're seeing about 12.5% on a lease trade out right now on our first properties. So we're still seeing slight market rent pushes. We're still seeing the growth on the renewal side. And meanwhile, we're building that retention with our residents as well. But it's a highly popular submarket just because of the demographic. It's really feeding into that population growth that Texas is seeing, and in particular that workforce housing where we provide those options. Amanda, I'll kick it to you.
Yeah, it's an affordable pocket, and we expect it will continue to be. We like to look in the secondary and tertiary markets. We know that most working force, housing it's needed because our residents are the ones commuting into the city to report to jobs. And we've really focused a lot on DFW because we love that it has that big airport. We love that there's a lot of Fortune 500 presence. There's so much job growth that we expect to continue and specifically support in the VC space. Gosh, we're getting a Universal. I mean, we're having all the theme parks, all the things coming. So the entertainment's important. The job growth leads to population growth. And we just continue to see that from each of the coasts, migration into Texas. And we feel strongly Texas will be a great market for the long haul for us. But we've turned down business in other cities because if we're not there and we're not experts, we're not the best ones to run your deal. And so, we've grown a lot of exposure and building relationships through situations like this. So we're so appreciative of the opportunity to come in and present today. But we also will be really upfront. If we're in a market and we know we can do you well, we're going to shoot that shot. If not, we're going to say, Amarillo might not be our spot, or Corpus might not be our spot right now. But it's really in the best interest of our relationships and the best interest of your property too, honestly.
Okay.
Thank you.
Yeah, and to piggyback on that, at the end of the day, we want to be a resource for you. So I've put our emails and our websites on the screen here, but again, reach out to us. We can help with acquisition, due diligence, underwriting. The sooner we're involved, the sooner we can help you with that business plan and make sure on an operational level, it still makes sense. But more importantly today, should anyone want a copy of the CoStar market report, we can pull any market, DFW, San Antonio, Austin, Houston, please email us. We'd love to send out those resources and continue to be a resource for anybody on the call today.
Thank you, Katie. There's one other thing that stood out to me, and that was the sales volume graph on one of your slides. It said 1.5 trillion in commercial real estate debt, like last year, I think, and then like it was almost flat this year, like,
Yeah, you're referring, that was the sales, yeah, just overall sales in the real estate market. Yeah,
right,
sales have come way down. Yes.
like
Well-
almost zero on that this year.
It has
No
been
way.
it has been quite a, one slide back, Katie. Yes, it's been
One slide
quite
back.
It's one-
quite a
that one.
bone rattling wake up call. And that's what happens when rates go from 0 to, will be, north of 5, trending towards 6% soon. The U.S. Treasury, I think, topped out at 3.38 today, somewhere near there. It makes it very difficult, and you had a lot of people buying at, buying at trailing 4 caps. Now that are looking at, deals that they probably can't operate as efficiently. They're running out of cash, and they have a sales broker telling them that they may be able to get a 5.25 and a 5.5 or a 5.5 cap on the deal. And that's just the reality. And until, sellers will hold out as long as they can, until they're given in, until they either get helped out with additional capital, or they succumb to the market. So yeah, it makes for an interesting back half of the year. But as markets start to settle, I think we've seen inflation come down just a tad. Obviously, economists think that the ultimate goal is to get inflation back to where it belongs, sometime in either 24 or 25. Don't quote me, but these are our realities, and these are we have to play in. So continue to ask questions of your GPs, and no question is a dumb question in this game. You'd be surprised at how many questions go unanswered. We're always happy to answer any questions, whether it's something you're looking at or otherwise. We're always happy to be a resource.
Thank you, Tyler. We are underwriting lots of deals. Of course, there's not many working out right now, but thank you for that service. And if I could have a screen share back, we'll
Yes.
do our little one lucky winner spinning wheel of names. So we'll give one lucky winner, we'll give a $10 Starbucks gift card to, check it out.
Oh my goodness.
This is a Google wheel of names. So Google stopped it there. We had no control over where it stops, right? So we will email you the $10 gift card in the mail, Starbucks card. You just open your email and scan it at the Starbucks store, and there's your coffee.
Well, thank you, sir. And thank you for having us today.
I very, very much enjoyed it. Thank you so much. Thank you for your service. And thank you for sharing this today, Amanda, Katie, and Tyler. And give another chance for anyone to ask questions. Unmute yourself. Ask a question if you have it before we wrap it up.
I'm sorry you didn't have more customers. I guess that would be it, but it is the weekend, or 4th of July Eve or Independence Day Eve, whatever you want to call it. Some
Right.
people are thinking of cooking on the grill rather than playing in apartments.
I don't blame them. I'd
Yeah.
like to be there too. All right.
For anyone that watches after the fact, please feel free to reach out to us should you have any questions, comments, concerns, or if we can provide some additional market data to you.
Absolutely. Thank you so much, Katie and Amanda and Tyler. Thank you, Charles,
Thank you.
Sanjeev, Jared. See you next week.
Thank
Bye.
you.
Thanks, everybody.
Thanks, all.
Goodbye, Herb.
Bye. It's not. Thing is sort of locked up. It's not. Yeah. Typically I do N and it says N for all. Here's screen, share, it's nothing's. Yeah, there. Or what? This, oh, maybe it's this.